Big business software provider Salesforce blamed, quote, budget scrutiny for its first revenue miss since 2006. The stock is getting killed, down 20% today on weaker guidance due to what city analysts are calling macroeconomic challenges. And those macroeconomic challenges relate to the dire state of U.S. consumers that is more directly impacting the businesses that service them. Retailer Kohl's is seeing its stock crash by 25% as overall sales were down sharply. Quite simply, the company stopped offering clearance sales so fewer people shopped in its stores. These are yet more examples of the recessionary environment. Call it a vibe session or whatever euphemism you want to use. The Kohl's CEO said it was, quote, uncertainty in the consumer environment, but that's not really the case. And we got updated GDP estimates for Q1 that reinforce this struggling economy. Revised even lower, it also included a look at GDI as well as corporate profits for the first time for the first quarter. We've got more and more. The data in all of its forms is moving into the wrong category. Soft surveys, hard figures like GDP, and now too many corporate reports to even keep track of. And these also reinforce the notion that not only is the economy off, so is the stock market. Stock indices are at or very near record highs, but that doesn't mean the stock market itself is booming, and it sure doesn't mean the economy is. Just ask Salesforce, Kohl's, like Target, McDonald's, KFC's, and so many others. So we'll start with Salesforce. Again, the stock is down 20% at last check, due to the first revenue miss, as the company says, not only did we miss our estimates, we're guiding into the single-digit revenue growth for the first time ever. Shares of Salesforce tumbled 20% Thursday morning, putting the stock on pace for its worst day in nearly 20 years. Its worst trading day on record is July 4, 2004, when the shares fell 27% just days after the company went public. The drop comes after Salesforce on Wednesday reported fiscal first quarter results that missed Wall Street's estimates for revenue for the first time since 2006. It also gave lighter than expected guidance, and that's where really people are focusing. Not only was it a revenue miss, they said for the next quarter, the second fiscal quarter for 2024, sales are only going to grow by 7.2%. That's their projection, and they've never had a single-digit revenue growth at all in their entire history. So people are naturally thinking, well, something is wrong with Salesforce. To their credit, City analysts said broader macroeconomic challenges, quote, returned with a vengeance during Salesforce first quarter. They noted that the period has also been weaker for other software companies, but that execution issues and changes to Salesforce go-to-market strategy also impacted the company's performance. Salesforce saw budget scrutiny and longer deal cycles than usual during the quarter, according to President and Operating Chief Brian Millham, as he told analysts on a conference call. So he says budget scrutiny, which is really another euphemism for companies aren't spending and investing money in the way that they used to, or the way that Salesforce actually needs them to. So the investment climate among corporations that Salesforce sells to must not be as robust and strong and resilient as everyone is saying about the macroeconomy. Businesses all throughout it are under pressure, to the point that the customers of Salesforce are saying, we're looking at our budget numbers and we don't have a whole lot for you this year. That's the longer deal cycles that Mr. Millham was talking about. Corporate America is actively taking steps to reduce their costs, their investments, their utilization of labor. This is just another indication among all the growing list of all looking at the same things and coming to the same conclusions. But of course, many people are saying, well, no, this is different. Salesforce is actually being impacted negatively by the AI boom. The outlook is heightening investors' fears over Salesforce sliding sales growth in the past year as the company has turned its attention to bolstering profit. Management has touted the potential for artificial intelligence-oriented software and features to boost revenue. But again, many analysts are saying, well, this is just AI taking market share from Salesforce. But when you go back and look at Salesforce's results, the revenue estimates and actual revenue growth over the last couple of years, it's very clear that, of all people, the Citi analysts have it correct. That you look at the timing and the deceleration in Salesforce's revenue, and it goes back to the third and fourth quarter of 2022. You're talking about 22% sales growth in the second quarter of 2022. Then that decelerates sharply to 14% in the third and fourth quarter of 2022, where it stayed around 10% growth up until the end of last year. Now, first quarter of 2024, we're talking about 11%, and then the second quarter projected to be 7%. So you've got a step down in the economy. At the same time, you see a step down in Salesforce revenue back in 2022, that inflection we keep coming back to all over the place, all over the world. And then what seems to be another step down in revenue growth. At the same time, we're hearing the same things from companies all over the economy too, as well as all sorts of economic data, which we'll get into in just a moment. But where Salesforce is just seeing its revenue slow down, you've got retailers like Kohl's and Target. Kohl's saying our revenues are actually contracting at an alarming rate. According to their recent report, Kohl's net sales dropped 5.3%. That's a huge drop. And comparable sales decreased 4.4%. And this is what the company press release said. Regular price sales increased year over year with early success in underpenetrated categories, positive trends in our women's business, and continued strong growth in Sephora. However, lower clearance sales versus last year represented a more than 600 basis point drag on comparable sales. Importantly, we were able to deliver gross margin expansion, manage inventory down 13%, and tightly control expenses in the quarter. What they said was lower clearance sales. They stopped having the same amount of clearances and suddenly revenues dry up. Without the lower prices to bring in shoppers, there weren't nearly enough shoppers for revenue to continue to grow. Consumers are absolutely price sensitive. And with Kohl's not offering the same deals through clearance sales, they don't bother to show up at all. Thus, the terrible results that Kohl's just put up, and of course, a 27% decline in its share price. But the company also referred to inventory, because this isn't just about Kohl's, nor is it just about consumer spending. Inventories, they managed inventory down 13%, which has an effect down the supply chain. Wholesalers end up holding too much inventory, so they stop production from manufacturing and say, we don't want any more goods because we can't sell it to retailers who are managing their inventories because sales aren't keeping up. It's the reverse bullwhip effect that we continue to see in all sorts of economic data, including soft surveys, the PMIs, as well as hard data like industrial production. In fact, those two things line up really well. So we're getting a comprehensive, complete picture. And yes, Salesforce and Kohl's might be anecdotes, but they're just the latest anecdotes that fit within the larger picture that is being built out by a wide variety of economic accounts all over the economy, and really all over the world. As Kohl's CEO said, we recognize we have more work to do in areas of our business. We are approaching our financial outlook for the year more conservatively given the first quarter underperformance and the ongoing uncertainty in the consumer environment. That's the thing. It's not uncertain. It's actually becoming very certain. And it's only uncertain because all that people have heard, including CEOs from their economists that they speak to, is that the economy is resilient. Jay Powell says so. Janet Yellen, everything is booming, holding up really well. It's strong. Labor market in particular. And if the labor market is strong, consumers should have plenty of money to spend in their stores, in everything else, in services, in Starbucks. But these companies keep telling us consumers don't have money. And the reason they don't have money is because the job market is more like the household survey than the establishment survey. And overall incomes, they've never kept up with price changes. And now they're at risk of falling even further behind if they're not already. It's not an uncertain consumer environment. It feels like recession because outside of layoffs, we're already there. On the road to recession, we got GDP figures. If you go back a couple of quarters, GDP put up 5% or very close to 5% in the third quarter of last year. And everybody said, oh my God, this economy is absolutely red hot. But as we have the benefit of hindsight as well as perspective, we see that, not that we couldn't tell at the time, that was more of an anomaly and an aberration than it was representative of a red-hot, strong economy. It has been downhill ever since. And remember, the third quarter last year was boosted tremendously by artificial government spending, among other artificial, one-time, transitory factors. So third quarter last year was indeed an anomaly, to the point that As of the first quarter of this year, the initial estimates for GDP that came out last month, they were the weakest in 2 years, going back to the technical recession in 2022 that represented the inflection or the change in economic trend from the upside of the supply shock to the where we are now, still the downside of the supply shock. Well, according to the revisions we got today on GDP for the first quarter, that 5% third quarter is a distant memory. Not only is it the lowest in 2 years, it's even lower than we thought initially, down to 1.3%. And the reason it was revised lower was because nominal GDP was revised sharply lower. You never see any of these big headline numbers revised this significantly lower on a short run basis from the first estimate to the first revision. Nominal GDP was revised by almost $30 billion, which may not sound like much in a $28 trillion economy, but at the margins, that's pretty substantial. By revising the figure down by 28.57 billion, that reduced the nominal growth rate from 4.77% to 4.35%. So, 0.4% in the initial revision is a pretty substantial downward revision. Of course, that filtered into real GDP. The GDP deflators, the price numbers, really weren't changed all that much, though each one was revised lower by 0.1%. So really not much of a change in prices, just nominal spending more than anything, but in the nominal economy. PCE, or personal consumption expenditures, those were revised lower too. That's where most of the revision was focused on. So lower consumer spending, where have we heard that before? It's not that consumer spending, according to GDP, contracted. It grew at a much slower rate, and growing at a much slower rate in nominal as well as real terms means that the pie is growing much slower, which then leads to all these problems amongst these retailers and consumer companies, because now they have to compete for a pie that isn't growing as fast as they were expecting it to have. So as consumer spending grows at a much slower pace in nominal terms as well as real terms, that means that all sorts of bad things happen from there. That's just the first step. It's not really the first step, but it's the first step in the bullwhip effect, as we just talked about. Inventories were revised lower in the first quarter of GDP, down to a contribution of minus 0.45 points from minus 0.35 points. So a tenth of a percentage point was subtracted more off of GDP because inventory growth was even weaker than initially thought. At the very least, the economy has slowed way down from last year. And it starts to make GDP as a whole look more like what we're hearing from companies, all these reports, as well as what we're seeing in all the other data, especially the divide between the establishment survey and the household survey. More and more of the economic accounts are moving in the direction of the household survey, not the establishment survey. With the first revision to GDP, we also get the first estimates for GDI, or gross domestic income. And gross domestic income is supposed to be the opposite side of GDP. For every expenditure, there's an income on the other side. If I spend $1, that's a dollar worth of income to someone else. And normally GDP and GDI do track very closely together, though they do diverge at noticeable points in history, usually around a recession. I talked about that in previous videos, and what we see from GDP and GDI over the last couple of years, going back to the technical recession, the first half of 2022, meaning the inflection point in the economy, the point at which we went from the upside of the supply shock to the downside. What GDI is telling us by diverging from GDP is that the economy, since that inflection point, has been much weaker than GDP has made it seem. So GDP isn't all that great. It is well below the 2010s baseline, which means that real output hasn't gotten back to pre-pandemic baseline at all. GDI says, along with a household survey, that it's much worse than that. Much weaker background economy helps explain everything that we're seeing this year, including the half recession or vibe session. It feels like a recession, but the numbers don't all look like one. Well, that's really the reason why. We're on the downside of the supply shock. We're in a cycle, a downturn, a contraction. Yet, according to the mainstream numbers like the establishment survey and GDP, it doesn't look like a recession. But it is. And we have data that suggests that it's more like that than not. And GDI, like the household survey, shows that the economy it's not just weaker in 2024, it's been weaker all along. So that the deceleration that we're picking up since last October, that happens in a much weaker background environment, which means we're in bigger trouble than we otherwise thought. And one final note from the GDP numbers, corporate profits. We got the initial estimate for those. Corporate profits, at least the profits for current production, were down 2.4%. That's at an annual rate. They had been up very sharply the 2 quarters before that, so it's hard to make too much out of a single quarter. But a setback or a stumble in corporate profits would go also a long way to explaining why businesses are doing more as far as their labor, cutting hours, less full-time jobs, more part-time jobs, that kind of thing, maybe even thinking about layoffs. And you also see the same thing in the GDP estimate for corporate net cash flow. That was down 8.4%. That's an annual rate, again, quarter over quarter annual rate. But that's the first decline in corporate net cash flow since 2021, suggesting that there may be a little bit more urgency to controlling cost or the budget scrutiny that Salesforce was talking about. Then again, the strong, resilient economy would make it seem like it was appropriate. Budget scrutiny, negative cash flow, uncertain consumer environment, all of these numbers, reports, Target, Kohl's, all of it, it all continues to point in the same direction. It isn't one thing or another. It's a lot of things. And there are more moving in the direction of the downturn cycle than not. Companies are reporting that consumers aren't holding up, and that's backed up by hard data, including what we just got in the first quarter of GDP. Even GDP has suggested a stumble, which is likely worse than that series, because GDI continues to indicate the background economy is closer to the household survey than the establishment survey. In other words, the downturn continues, and it continues to get worse, which is consistent with everything that we're hearing and seeing. They've called it a vibe session, and they use other euphemisms to try to describe how everyone feels because, according to the mainstream view, it doesn't look like a recession. I've called it a half recession because it is in every respect, save the one, just like a recession. We're already halfway there, if not further, and the data continues to support that view. It's not just Kohl's. The setback in consumers, the stumble in consumer spending is being felt all across the retail industry. Talked about Target and Walmart, then the video link below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.